Ladies and gentlemen, on behalf of Captify Consulting Investor Relations team, I welcome you all to the H1 FY26 post-earnings conference call of Shree Refrigerations Limited. Today on the call, from the management team we have with us, Dr. Ravalnath Gopinath Shende, Chairman and Managing Director, Commodore Sunil Kaushik NM, VSM Retired Whole-Time Director, Mr. Abhijit Saoji, CEO, Mr. Manoj Kothale, CFO, and Ms. Devashri Nampurkar, Whole-Time Director. As a disclaimer, I would like to inform all of you that this call may contain forward-looking statements, which may involve risk and uncertainties. Also, a reminder that this call is being recorded. I would now request the management to run us through the investor presentation detailing us about the business, performance highlights for the period ended September 2025, their growth plan and vision for the coming years, post which we will open the floor for Q&A. Over to the management team.
Thank you, Vidan. Welcome, honorable members in this conference call of the first H1 earning call from Shree Refrigerations Limited. As a tagline, we don't manufacture products, we manufacture pride. That is by way of developing mission-critical, complex technical HVAC solutions for the Indian naval warships and submarines. Next slide, please. Next slide, please.
Please go to the next slide.
Yeah. Inside Shree Refrigerations, leading defense-oriented manufacturer of high-performance refrigeration and air conditioning solutions for the Indian naval warships and submarines. To begin with, I must say, I have to tell my honorable members in this call here that we are the only Indian HVAC manufacturing company to have been qualified by 3 professional directorates of Indian Navy, Directorate of Marine Engineering for air conditioning plants, Directorate of Architecture for the air conditioning, and the Directorate of Electrical Engineering for the electrical control panels. All the 3 registrations together enable us to provide a totally in-control end-to-end solution for the Indian defense naval warships and submarines. Next slide, please. Indian defense naval air conditioning was facing challenges in terms of dependence on high-cost imports, lack of local support, and Shree Refrigerations decided to accept the challenges in terms of engineering to meet the naval standard, military grade specification, cost effectiveness, as well as compliance to the defense and industrial standards of MI grade. Next slide, please. Next slide, please. What drives us is the mission to provide reliable, high-quality equipment for the defense needs. Vision is to build a stronger nation by way of very strong supported indigenous products and cooling solutions. And the purpose is to contribute or participate in the Make in India and Atmanirbhar Bharat initiative of the Government of India, creating a locally manufactured, designed, developed, manufactured products which will meet the exacting standards of Indian Navy. Next slide, please. Next slide, please. The journey of Shree Refrigeration started by me way back in 1990 as a manufacturer of domestic air conditioners, which went on to switch to industrial applications like milk cooling and newspaper printing chillers, which graduated into making spray damping systems for the newspapers. And in the process, we also made critical import substitute products for testing the cooling capacities of compressors by way of making calorimeters, the cooling capacities of air conditioners by way of psychrometric rooms and balanced ambient calorimeters, being the only company in India to do that. In 2012, it started its journey in marine refrigeration and air conditioning, a very struggleful 4 to 5 years. Started bearing fruits in 2016 when we did the first major warship air conditioning of INS Dhruva. 2017 was a watershed event in the company's history and even India's indigenization success story of developing the submarine air conditioners for the Scorpion submarine completely in India without any foreign collaboration by my company. And I'm glad to inform my August audience here that the last Scorpion submarine INS warship is completely installed with Shree Refrigeration air conditioners powered by Shree Refrigeration panels. The next challenge thrown to us was to induct oil-free magnetic bearing compressor chillers in the Indian naval scenario, air conditioning plants, and we accepted that in 2018 by way of doing a technology demonstration, by way of participating in a tender for Project 17 Alpha warships, and eventually beating all the multinational competition to win that contract. Subsequent growth in the market has been astonishing, even by any standard that we went on to when shallow water corvettes contract, we went on to when fleet support ship contract, all the three contracts of the fleet support ship, which are being currently manufactured in Hindustan Shipyard Vizag, like refrigeration plants, key air conditioning and air conditioning plants are run by Shree Refrigerations. This, of course, required expansion in the capacity, expansion in the financial strength, which happened by way of securing strategic investment from Maharashtra Defense and Aerospace Venture Fund. Then it took us in 2024 to shed the private limited tag and become a limited company. And then in 2015, all my August members here have been well aware, have now get an opportunity to be a part of the growth journey of Shree Refrigeration. Something that started in 1990 with a 10,000 rupees investment, today posting 100 crores turnover last year. Subsequent numbers will of course be shared by my CFO. Next slide, please. The team that we just discussed, myself, this is Rajeshri, our executive director. Devashri is a full-time director. Commodore Sunil Kaushik has been through various stages of Indian naval segment of warship production, running a warship, maintaining a warship, a whole lot of portfolios that he handled in his team career that won him 2 awards, NM and BSF. We are proud to have him as a full-time director on board. Next slide, please.
So before we move to the next slide, due to your bad throat, the voice is not audible. Could somebody else continue with the presentation, sir?
My name is Abhijit Saurji, and let me continue with this presentation. I hope I am audible now. Is that?
Yes.
Sure. Well, coming back to the board of directors, the board of directors which you are seeing is from a promoter family. The slide which is right now you are viewing are the independent director, Colonel Lalit Rai, who I don't have to introduce him. He is a war veteran, a Kargil war veteran, medal winner, and as well as been a big name in the HR industry. Commodore Vivek Karnawat, who's an executive officer, retired from Indian Navy, have a long career into a financial segment, handling insurance, handling a lot of investment in a lot of other companies. Mr. Atalay is an ex-vice president of L&T Precision Engineering, dealing with the defense industry. Mr. Shastri, who's a CA and CS, he has handled a lot of CFO position in various Kirloskar companies. Currently, he is an independent director with us. Can we have Okay. This is the Shree Refrigerations team. You can see the average experience of this particular team is around 25 odd years experience. So it's well headed by various people. I will not get into a detail of it. Next slide. Let's look at a business review. When we talk about a business review, the picture what you see in this slide is actually what we are proud, and I can rather divert from this presentation. This is the chiller which we have supplied to a project called as P17 Alpha. This is the first big order which we got. The order value was around 150 crore, and I'm proud to say we have completed this project in given time frame by the Indian Navy. This is the first time this kind of a technology got introduced in a naval platform in India, and we had delivered it, meeting a still requirement. Can we just okay? Is that okay? Okay. We are right now handling an HVAC solution where we design, manufacture, supply, install, and obviously handle the services and spare parts for the Indian naval ecosystem. The business comes from this. When we talk about design and manufacturing supplies, basically for a new build ship as well as the retrofit ships. And as all of us are aware, the defense segment or defense ecosystem also has a service and spares business at a substantial level. Even though the product mix which you see for the first half may not, give my statement credence, but when you will see probably at the end of the year, you will realize that what the statement which we are making are very true. Next slide. Okay, these are the some product which we have designed. Few of the product, if I talk about, is the marinized split air conditioner. This has never been done. Most of the ship has over a period of time has lot of what you call as a heat pocket where they have been buying the split domestic air conditioner, which has resulted into a lot of accidents. So on the challenge given by Indian Navy, we created a marinized split air conditioner. The product which you see are the submarine air conditioner, everything else. Let's look at it after. Next slide, please. Okay. This shows you the manufacturing facility which we have. Currently, we are operating at two manufacturing facility. Around 40,000 square feet of a manufacturing facility is available for us currently. We are also in the phase of building up our own new manufacturing facility around 50,000 square feet. This is the first phase of it. We will have a few more phases coming as and when the business potential gives the green signal to us. All the manufacturing facilities are located around 180 km from Pune towards Bangalore highway. Towards Bangalore, sorry. Next slide, please. This is the most important slide according to a defense ecosystem, because when we create an equipment, all the equipment has to be tested 100% level. There is a testing protocol which has been given by the defense ecosystem, and those are the most critical, most what do you call it? Most important. And the best part about it, all these test equipment are designed and manufactured by ourselves. I don't know whether you recollect Mr. Shende in his slide of journey of a celebration mentioned about a test equipment. Today we have our test equipment almost installed on all the refrigeration appliance manufacturing company, whether it is LG, Godrej, Emerson, Tata Motors. I can rattle out the name. But when you come back and look at this test facility, the right hand side picture, when you read controlled ambient AC test room, we are the only people who have this kind of a test room which tests the HVAC system. All my friends in the industry are testing the HVAC system in a normal or open ambient temperature. So today, this kind of test facilities are only available with Shree Refrigerations. Can we have a next slide, please? Okay, where are our presence? And obviously, you can see all our presence are near to the port, because most of the customers are near to the port. Sorry, the team has not added one more name. There's a Chennai. Also, we have now a installation and service team. Next slide, please. When we talk about this kind of a manufacturing facility, when we talk about this kind of a product range, obviously, we need to have our own competitive strength. One strength which we have is basically having a certification from all three directorates. That's important. Second is obviously in-house manufacturing. Today, most of my friends in the industry are a system integrator. We have created that difference in this industry by having our own manufacturing facility. Today, it is completely backwardly integrated and forwardly integrated manufacturing facility we have. As well as we have a huge design office, which we will see in subsequent slide. We have almost 21 people in design as of today. An important thing, I just shown you an earlier slide where we have an after-sale service across all the ports. Next slide, please. Strength, weakness, and analysis. I think all of you must have done a SWOT analysis for Shree Refrigerations. Let me go to the strength, most important, the design, manufacturing, service, and having all the certification and as well as the quality clearance from the defense ecosystem are our strength. Opportunity, do I need to say more? The defense ecosystem today has pregnant with a huge opportunity. We will talk about a number probably when we will discuss with you separately. Can we have another slide? Okay, these are the few certification registration which you see. As we've been mentioning, we have a certification or registration from all the defense directorate. That is quality worship, that electrical engineering, mechanical engineering, and as well as construction. We also have a Z Gold, zero defect in our manufacturing, given by Government of India, IRS, DQA certification, and CE obviously for some of the product. Can we have a second slide, sir? Financial highlight, let me pass on the baton to Mr. Manoj Kothale, who is a CFO, and he is the number man.
Thank you, sir. I will put highlight on the financial performance during the first half of our company. During this period, we generated revenue from operation of 50 crores. Our EBITDA margin remained at 11.2% and net profit margin was 2.9%. The margins were impacted due to new HVAC orders execution on site and loss on-site manpower and long billing cycles impacted the short-term margins. We strategically expanded our team size from 247 to 323. The front-loaded employee cost has impacted the margin during the first half. The revenue recognition will be following in the subsequent financial periods. Nonetheless, we are expecting to maintain the long-term EBITDA margin somewhere between 20 to 22%. Next slide, please. Our opening order book during as of April 1st, 2025 remained at 215 crores, to which we added 162 crores of new orders, out of which we executed 50 crores of orders, and as of 30th September, we are having 327 crores of orders in hand to be executed over upcoming 2 to 3 years, for which we have already employed our team. That's why the employee costs were front-ended and revenue will be following in upcoming financial periods. Next slide, please. This is the financial performance over the past 3 years. From 23 to 25, our revenue grew at the 40% CAGR. Our EBITDA grew at 50% CAGR. Our PAT has grown at almost 5 times as compared to FY23, and our EPS grew at 101% CAGR. Next slide, please. This is the figures we have already shared. Way forward.
Now, let me Kapur Kaushik handle this. He is the one who's actually also looking out. Sir.
So, we are already well entrenched into the defense segment. as you're all seen in the presentation. As we go forward, we are going to extrapolate this marine segment and move away from not only defense but also the non-defense applications. As you all must have heard, the government of India thrust on merchant shipping, merchant marine. We are expecting to have upwards of 200 ships in the coming orders for upwards of 200 ships being constructed within our country in the next 3 to 5 years. It's a huge, huge potential, and Shree Ref is absolutely well poised to take advantage of what we've done in the naval segment into the non-naval segment. We have also gone into from sea onto land by entering into an agreement with one of the global leaders in providing data center cooling solutions. That is Messrs. Smart. With this, we are intending to leverage our expertise in oil-free compressors, which so far we've been using at sea onto land. And we are going to be in partnership with Smart, providing cooling solutions for data center cooling. This also represents a very, very big opportunity, as all of you are aware. It's a number which is expected to grow almost double in the next 3 to 5 years, from the present level of about 600 billion to almost upwards of 1 billion in the next 3 to 5 years. So the opportunity for Shree Ref is huge, and we are very, very well poised to leverage these opportunities. Next slide, please. So I don't have to, say this again. As I already mentioned in the previous slide, there is a huge opportunity which is in front of us. We have already taken steps to be able to meet that opportunity or whatever challenges it throws onto us. We've already got our manpower in place. We've already got our factory spaces in place. And going forward, we are expecting to grow in about 40 to 50% CAGR because of the kind of opportunities that are there. Thank you. Next slide, please. We've got our own, these are some of the people whom we are working with. I don't think I need to elaborate much on this. We go next, please. So thank you. That's in a nutshell what we do at Shree and what we've done in the past 6 odd months, what we presented to you. I think we are now open to taking any questions.
Sure, sir. All those who wish to ask a question may use the option of raise hand. In the initial round, we'll request you to ask only 2 questions and let others have a chance to ask questions. We'll take the first question from Garvit Goyal. Garvit, you can go ahead, please.
Hello, I'm audible.
Yes, Garvit.
Hi, good evening. So first question is on the order book. The current order book that we are having, what is the execution timeline for it? And while we're speaking about 40 to 50% growth year over year, so this year, how we are going to meet the targets? That's my first question.
If I understood your question I had to divide into 2 parts. One is the order book position and the execution time of it. The second one is about the CAGR rate, how we are going to grow. Okay, let me answer it. The current order book position as of today, probably you are aware of it, is 327 odd crore rupees. And the execution time for 327 crore of order book position is around 2 years time, sir. That one. The second part of the story, how we will grow by 40 to 50% CAGR rate. So the market is growing at this ratio, and we will grow along with the market.
So, Garvit, just to add on to what the CEO has said, you're all aware and you're all reading how our government is actually giving acceptance of necessities or giving approvals for growth in the defense sector in general and the Navy in particular. So based on the kind of approvals that the government has given and the kind of future approvals that are expected from the government, we see that the market is growing at about 40 to 50%. and our growth is going to be absolutely mirroring what the government is going to approve. That is actually at a conservative level, because what we're talking about is only the defense or the marine sector. Right now, we're not factored the data center ecosystem, which we are going to add on to this. So we are very, very confident that we will meet this kind of a growth target.
No, sir. I was specifically asking about FY26. Like, first half is more or less muted for us as compared to first half last year. So I just want to understand, like, to achieve that 40% growth this year, how are we going to do it? Like, what for that purpose we need a significant execution in H2. So, what is giving you that confidence?
In the first half, where as per the requirement of the customers, the second half delivery requirement from the customer are much higher as compared to first half, and we will be meeting the targets as has been projected by us.
And we have been responding to the scenario by renting another 20,000 square feet of factory and recruiting a whole lot of manpower to be able to meet the customer delivery expectations.
And sir, regarding the net margins, last year our net margins were around 14%. So, what is the trajectory here? Like this year, maybe because of the higher employee expenses and other expenses as well. What is your target for this year? Like, and how the trajectory will be going ahead?
Expecting to maintain the net profit margin as of last year, this year also.
No, that's what I'm trying to understand. How is it possible? Like employee costs are significantly elevated, right? So I'm trying to understand, like, how is it going to possible?
See, we've got a very robust order book, as you can see, right? And there is a very clear visibility of the revenue based on what is the expectation of delivery by the customer. So what you've seen this half is exactly what the customer needed or wanted. So we met what the customer's expectation was. Going forward, there is a heightened requirement that the customer requires for us to deliver over the next 6 months. All those deliveries are already at various stages of manufacture. So we are very clear that we are going to meet the customer's expectations over the course of the next year as well. So it's based on that we are indicating to you what the figures are.
As Mr. Samji already, just give me a second. As Mr. Samji already told in his presentation that in-house manufacturing is the strength of Shree Refrigeration that gives us a total control on quality, cost, and delivery. And we are strengthening our manufacturing processes by introducing robotic building at some places, assembly line production in a variety of products, which will reduce the delivery time, which will enhance the throughput time in the factory, which will add directly to the margins.
To add this, one week. To add this, our revenue in the second half will be much higher as compared to first half, and the fixed overheads will not be increasing at the same ratio. This leveraging of fixed expenses will contribute to the bottom line, and we will be meeting the last year's target, last year profit margin this year also.
So on full year basis, we will be like 140 CR top line and maybe 20 CR kind of PAT is what you are targeting. Is that understanding correct?
We will be in the range of around 140 to 150 crore of a top line, with a similar percentage of a bottom line as compared to last year.
Got it. Got it. Thank you very much, sir, and join back the queue. Thank you.
Thank you so much.
Thank you, Garvit. We'll take the question from the line of Meet Katrodia. Meet, you can unmute and go ahead, please.
Yeah. Congratulations on the gold order book in the core defense business. Sir, I want to set some context. Earlier, when we have tapped with the smart DT for Navy chillers, we were successful to drive the MNC out of the market, but maybe it was maybe due to the smaller market, and maybe MNC was not even focusing on the Navy business. So my question is on the data center opportunity. Like globally, large data center chiller market is dominated by very few multinational OEMs. And as per our feedback, getting approved by the hyperscalers and even consultant is usually quite difficult. So could you help us to understand like what specific edge you have versus the global large global players? I know that we have tied up with the smart DT and it is a oil-free magnetic bearing technology, but our core competitor also have this tech. So just want to understand how you are penetrating this market.
I'm glad to inform my august audience here that Smart have already approved vendor with most hyperscalers like NTT, Evenix, AWS, and a whole lot of them. The only thing that has changed in the Indian context is now we have partnered with the Smart to provide the local support system. So the market is now wide open with a pre, like in Navy case, we were registered and we were leading the show. In this case, Smart are already registered with one of the most hyperscalers, and we have that advantage of getting into the segment with Smart. No special approval procedure needs to be taken up in India for getting into the data center market, mainly for the hyperscalers.
Okay, so you're telling that my understanding is that if you can correct if I'm wrong, Smart is already registered, let's say maybe Yota, SW, and we are only providing the support system currently, right?
In the early part of the story, definitely yes.
Okay, nice, great, sir. So secondly, on the data center solution, like you must be already be in the discussion with the multiple customers. So what kind of feedback are you getting from the market so far? Like what are your top concerns that, sorry, what are the top concerns maybe with Shree Refri, and adding to it also, what are the key approval milestones we need to track from the Shree Refri? Like if this milestone is clear, let's say 2-3 years down the line, we can expect that Shree can scale in that part of the business also.
Mr. Pitt, let me put your question into three different questions. The first is the initial feedback from the market when we announced our tie-up with Smart DT with a lot of hyperscalers as well as the local big players. And when they realize that we are coming out with a different solution which is not available in the Indian market as of today, so people are very receptive because data center as such is a technically very advanced ecosystem. So when we are coming up with an oil-free chiller which has an impact green sustainable solution, one higher efficiency. So obviously people are curious and people are so the immediate feedback is people are very, very positive about this time. Second thing, we are always known in the refrigeration and HVAC industry as a test equipment supplier to most of the refrigeration companies. Whether it is Carrier or a Blue Star, they are my customer. So our name as such is creating a critical equipment are always well known in the industry. So that is all going to obviously help us in putting our foothold in it.
The most important point is the location of my service team for the Navy, which is doing again the oil-free chiller solutions, and the strategic locations of data centers where the cables are going to land are the same. It's going to be Mumbai, it's going to be Chennai, it's going to be Vizag. That's an added advantage we have over the competition.
Understood. And sir,
Meet, I would
yeah.
ask you to please join the queue because there are a lot of participants waiting for that.
One last, can I?
Yeah, sure.
Please, can I ask you a question? You asked a very interesting question as to what are the cardinal points that you feel that you should monitor for assessing the growth of Shree Ref or the penetration of Shree Ref into the data center market, right? Actually, I would like to put it to you actually and understand from the market, as you are a representative maybe of the market as well as of course you are definitely part of the Shree family, as to what is it that you expect us to do so that we can meet your aspirations.
Basically, it's very hard to comment from our side that as an investor, we like to see the company scaling in the data center also, right? In the Navy and the defense segment, we have scaled up very well through the help of Smart DT and through the help of yours also, sir. So if in the data center, there was a concern only that there are many MNCs and they have focused on the chilling solution because chilling is a major cost of the data center, right? So when the MNCs are dominating this market in the globally also, then Shree Ref as a small company, how they can scale this market in India, it will be very interesting for us to track. So we are very happy to see that if Shree can scale in this business and how we are trying to penetrate.
Understood, Meet. Thank you for your trust in Shree Ref, and you can be rest assured that in the coming years you will find some great amount of penetration that's happening.
Thank you, mate. Thanks for
Thank you, sir.
Thank you, Amit. We'll take the next question from the line of Darshil Zaveri. Darshil, you can unmute and go ahead, please.
Hello, good evening, team. Thank you so much for taking my question. Hopefully, I'm audible.
You are.
Yeah, hi, sir. So some of my questions have already been answered, but so just wanted to ask, like when we say, we are delivering as per, customers' expectations or customer schedule. So is this going to be a recurring thing for us? Like, is H1 going to be a bit weaker always, and H2 will be the more profitable quarter, or how would we, consider seasonality for us, sir?
Okay, no, Darshal is not like that. See, shipbuilding itself is governed by the kind of orders that the government approves and the kind of order thereafter that the shipyards give to sub-vendors. At this point in time, it is such that the revenue cycles have been in this manner. In fact, it was similar last financial year as well, when roughly 20 to 30% deliveries were maybe in the first half, and about say 70 odd percent were there in the second half. That same thing is continuing this year, but going forward, it's not going to continue to remain like this. The deliveries or the revenue realization is going to be more even. This is based on two factors. The first factor is the existing status of the existing orders, whereby the deliveries are going to be more evenly spread across the year. And the second factor is the higher number of orders that are there on the annual and that we have either won or expecting to win. So when the concentration of orders increases, which is almost happening, the order delivery will also become very, very smooth. So to answer your question, with the present delivery schedule, as I mentioned, the revenue realization in the next financial year is expected to be relatively even across the year, and going forward, that's going to become the norm.
Okay, that helps a lot, sir. So just wanted to know, so we even had a small dip in terms of our gross margin this year. Like we usually were around 50%, and right now we are at 45%, I think. So EBITDA we can consider like there are higher employee cost, but so it's just the thing that even we are guiding for around 20% EBITDA margin, but previously we've done higher than that. So just wanted your commentary, like how do we see the EBITDA margin targets? Are we being conservative when we give the guidance, or what do we see that, sir?
So one more reason for EBITDA margin reduction is change of product mix. So last year the revenue from spares was almost 40%, and this year it is amounting for almost 8% of the revenue. So this has impacted the margins. Going forward, if product mix changes, the EBITDA margin will also improve.
Oh, okay. Fair enough, sir.
EBITDA margin somewhere between 20 to 22%.
Okay. Because I think in FY24 we are 30% and FY25 we are around 27%. So that's where I was coming from, because the significant reduction on the margins that we have, right?
One of the peculiar of defense business is that once you win an order, there is a certain amount of revenue visibility which is there for a very, very long term. Because after you deliver, install and commission, after you deliver, you install and commission, and after you commission, thereafter you sustain or you support it. Supported by way of services as well as by way of spares. So these two factors continue to give you a very robust revenue stream. So there is a good amount of visibility as far as, because we've got a large amount of orders, there is a good amount of visibility for a long term.
Okay, that's fair enough, sir. And sir, just wanted to know, like, H1 we had revenue saying FY27 we'll have more event delivery. So what kind of revenue targets we can have? Like I think the way we are saying about our order book to be executed, we should be able to cross like 200 crores, right, sir?
To answer your question, probably we put it into our presentation also. We are expected to grow around 40 to 50% CAGR rate for next 4 to 5 years easily. So you can easily make out what kind of a revenue realization we will have from an exponential year.
Okay, fair enough. I just sorry, one last question from my end. So this revenue growth you're speaking is about defense, right? Centers will be completely additional to whatever we, have that, right, sir?
Not only data center, even the non-defense marine that will also be in addition. So it'll all become plus plus.
So when would that start approximately? I don't want any exact, but we wish to start that when, sir?
Sorry, we didn't get your question.
So the non-marine defense and data centers, those part, will they start coming in from FY27 or how long will we have to?
They'll start trickling in from the coming financial year. It will start with a trickle. But I'm sure that all of you have seen in the past month or 2 months the amount of trust that the government of India has given, by way of the shipbuilding financial assistance scheme, by way of marine development fund, by way of setting up new greenfield shipyards. So there is a huge amount of policy trust that the government is giving, and for this realization, it will take about 3 to 5 years.
Okay,
Yeah, go ahead.
yeah, sorry. Like to cut you off, sir.
Thank you, Darshan.
Yeah, okay. Thank you. I'll get back in.
Thank you, Darshan. We'll take the next question from the line of Chintan Parekh. Chintan, you can unmute and go ahead, please.
Yeah. Thank you, Vinay. Sir, my question is to Manoj ji. Sir, on the reasons which impacted the margin, it is mentioned that the new orders required on-site execution. But usually, when we bid for this, we have this kind of a escalation clause or change in delivery location. So shouldn't that have covered the additional expenses which were incurred on this? And the second question is on the point which was mentioned called revenue recognition to follow in subsequent financial period. If you can help me understand what does that mean?
So what was the on-site site execution was we required to hire additional manpower for on-site execution. That has impacted on the margins. And so what was your?
Let me answer you. So what has happened, the execution part of the story, we realized the revenue of certain orders in the last financial year for which certain execution expenses has been put in first of this year. Is that what you're trying to say?
Yes, we have already hired the team. So, but the deliveries will be following the second, much higher part of the deliveries will be in the second half of the financial year. The deliveries are as per the requirement of the customers only. And the deliveries which are expected to be given in the second half are much higher as compared to first half of this year.
Okay. And so what do you mean by revenue recognition part?
Expected delivery dates of the customers.
Okay, so we mean to say that the revenue could not recognize because the delivery timeline got extended by the customer.
Delivery dates were in the country.
I will correct one point here. For something which is getting invoiced in the first week of, say, December, would have been started manufacturing in the month of April, March. It's a long manufacturing process for some equipment, and the line item was deliveries need to be clear. Like if I make 80 equipment and the order is for 90 equipment, I have to dispatch all of them in one lot.
Okay, and so our subsidiary Trezor, is it doing any business as of now? Are we, are we planning to set up manufacturing with the help of Smart, or are we going to just do the trading of or implementation of their products into
At this point in time, we are not going to be doing the manufacturing. Going forward, it's very much one of the options which is there on the table, but that's not the plan at this point in time. At this point in time, it is to be able to establish ourselves in the market.
So, because in earlier questions, sir mentioned that, the revenue from the data center business will come, in subsequent years. So if we are not manufacturing, sir, why that revenue will be delayed? Why can't we, kickstart that with the help of Smart?
The revenue will only come once the project is executed.
I'll break it here. The chillers that are getting invoiced in this financial year, the orders may have been placed 2 years before.
Okay, understood.
Because it is finalized at the beginning of the project. The execution takes 1.5 years. Chillers come somewhere in between.
Correct. But do we have any order book on the data center chillers, sir? As of
Chintan,
now?
Yeah, we have an inquiry book.
Inquiry. Okay, thank you, sir. I'll get back into the queue.
thank you, Chintan. We'll take the next question from the line of Paras Cheda. I would request all the participants again to please limit yourself to 2 questions only, since many are in queue.
Yeah, thank you so much, sir, for this opportunity. Sir, just first things, just a clarification to one of the participants who responded. EBITDA margins expectation has been lowered to 20% because of product change mix. Therefore, what would be the new normalized PAT margin now instead of that 14%?
PAT margin will remain somewhere between 13 to 15% this year.
Is
Am
it?
I audible?
Because we are now projecting a lower EBITDA margin.
Yeah.
Yeah.
But it will be on the higher revenue.
Yeah.
We will be meeting our PAT margin.
What else?
Paras, you are not audible.
So that the margins will be.
I think we'll move to the next participant. There's some
Yeah.
noise issue.
Am I audible, sir?
Yeah, you're audible now.
Sir,
Paras.
You're
Please
audible
go
now,
ahead.
sir.
Yeah. So I was trying to say the PAT margin that you mentioned is about what, 14 to 15 percentage points?
Yes. So it will be 13 to 14% for FY25-26.
And longer term also?
Yes.
Okay. And sir, given that we are, for sector exposure, etc., with our current capitalization, etc., what kind of peak revenue can be achieved? We have a capacity that is in place, right? We have got some, space that we have leased in, and another manufacturing facility is being built at a 1 lakh square feet, 50 plus 50. But given the working capital constraint, what kind of peak revenue capacity can we do, and by when will that be hit before another equity dilution comes into play?
I need to understand the question. Can you please repeat the question? I'm sorry, I couldn't able to hear you.
Hello.
Okay. No, sir, what I was trying to say, am I audible, sir? So what I was trying to say is that our company is in a sector which is working capital intensive. We have currently capitalized our balance sheet with whatever funds, IPO funds that we've raised and the previous reserves. So with this current capital and whatever capitalization that we have, what kind of peak revenue can we hit before we go for another round of equity dilution?
Sir, your question is basically from a financial point of view. Let me rather than answering.
Yes, because
Yes, sir.
yeah, sir, matlab jaise now we may have data center orders, we may have marine shipbuilding orders, we may have HVAC from defense orders. All of these orders we may get, but our balance sheet may not be able to cater to all these because of the working capital cycle. So I'm saying, what is the peak revenue that can be managed with the current capitalization without going for further equity dilution?
So as far as working capital requirement is there, we are working on improvising the working capital cycle. Further, our balance sheet is not heavily leveraged. so we can raise enough working capital required for further execution. And as far as we are growing at 50% CAGR. So
Yeah, but up to yeah. So sorry again. Let me reframe one more time. We have capacity. Okay, so let me put it this way: we have certain capacity.
Paras, let me try to help out over here. So
Yeah.
the question that he's trying to ask is that we've raised money through IPO. When is the next we'll look to raise money until we reach what size? Till what size are we good to go with the current funds that we've reached?
So, as of today, we believe that once we cross the threshold limit of 500 plus crore, we will not need any more capital raised from the market. And this is let's say from a capital side of the story, but let's look at it from an infrastructure point of view also. The infrastructure which we are today building up can cater to this kind of a revenue also.
Understood. Thank you, sir. And just one last query, sir. What is our current bid pipe? We have the order book, which is 327 crores. What is our current bid pipeline or the inquiries sum total?
What is the next part of the question? I didn't understand.
Inquiries. Market size.
So I will just tell you, Paras, the Defense Acquisition Council has in this year approved 10, have granted 10 AONs, out of which RFP for only 3 so far has been issued. So we are expecting RFPs to come out for about 1.52 lakh crores, in the course of maybe another year or so. That's for the existing AONs. The Indian Navy is also aspiring to, become a very large force. And we are looking at somewhere the target is from the present size to go to about 160 ship Navy somewhere around 2030, which is just about 3 years from now, and grow to about 175 to 200 ship Navy by the year 2035. So that represents almost about 60 odd ships that are going to be.
Sorry, sir, continue.
Is there any further clarification? I mean,
So just okay. So what is the current bid that you've done for these projects? And there is a vast opportunity. I have understood that.
Thank you.
So what is the current bid pipeline that he's talking about?
The current bid pipeline today till let's say March 27. If I do take some period, so I'm taking a period till March 27 will be around 800 odd crore rupees. Only from a naval ecosystem. If I add another marine ecosystem, we can add another 200 crore into it.
Okay. Thank you, sir.
Thank you, Paras.
Thank you, Paras. We'll take the next question from the line of Aryan Singh. Aryan, you can unmute and go ahead, please.
Good evening, sir. I'm Aryan from RKIF. My question is related to financials. We had higher interest cost in standalone financials of rupees or 9 lakhs compared to consolidated financials. So what is the reason for that?
Can you repeat the question, sir, please?
So my question is related to financial statements. We had higher finance cost in standalone financial statements rather than consolidated financial statement. The difference is of 9 lakhs. We have higher finance cost in standalone financial statements.
It is treasure. Shake, sir.
Can I keep this question on waiting list and answer to you by end of this meeting?
Yes, sir.
Thank you so much, Aryan. Can we take the second question, sir?
Yes, sir.
Answer back to this question. We close the meeting.
Okay, sir.
Okay, thank you. Thank you for your cooperation.
Hello.
Can we have a second question?
Hello.
Yes, sir.
Hello, I am Swapnil Sontaki. My question is on capacity expansion. Once the new 1 lakh square feet facility becomes operational, then what incremental revenue capacity will it enable? And by when do you expect phase one to start contributing to the top line?
Well, I answered you for your first part of the question. We are saying that up to 550 to 600 crore. We will not need any further manufacturing capacity once we have 100,000 square feet of manufacturing capacity already. That's first part of the question. The second part of the question, the first phase of it, which is what we are saying is 50,000 square feet, will be up and running from next financial year, start of financial year. And next financial year, our guidance are we will be growing by a 40 to 50% CAGR rate, and that will take care of it, sir.
Thank you, sir.
Thank you, sir.
Thank you, Sapne. We'll take the next question from the line of Srinatha. Srinatha, you can unmute and go ahead. Srinatha, you can unmute and ask your question.
Let's move to the next participant.
Yeah, so we'll take the next question from Rohan Chokshi. Rohan, you can unmute and go ahead, please.
Hi, sir. Am I audible?
Yes, sir.
Yes.
Very much.
Yes, sir. Firstly, congrats on the results, on the amazing results. And I've done some research on the industry that you work in, and I've heard that it's very, very hard to crack in, and it takes at least 5 to 7 to 10 years to get approved and get in the list of these big companies and to get to the level that you're at. So, firstly, huge congratulations. Are
Thank
you able
you.
to, sir, can you provide us some information on the industry landscape? Because it seems like you have cracked the moat of getting orders from these big companies. So, how hard or how easy is it going to be for someone new to come and do what you have done? Is my first question.
My favorite question. That's not easy, and one of the main results is the kind of focus a very committed MSME can have. Cannot be seen in larger corporations very easily when it comes to Indian market, and we have replaced some of the very large format companies within the defense ecosystem by virtue of pure strength, focus, and commitment. My team's commitment towards supplying good quality equipment, maintaining it on board, management commitment towards creating requisite capacity, hiring the correct manpower, and getting the proper designs. A lot of investment in the research, development, and type testing of the equipment to meet the exacting level expectations is not easy for a company that looks for results on quarter to quarter basis.
Well, let me just add on to what Mr. Chendia said. You're absolutely right when you have concluded from the research that entry into the defense is not easy. I will add on to that saying it is also not for the weak-hearted. The reason for that is because one, defense equipment requires extremely stringent testing, grade equipment. There are very cumbersome processes that need to be followed. Cumbersome is an inverted comma because they are essential, but to the industry at large, they seem cumbersome, but they are absolutely essential from a naval point of view. In addition to that, many people falter because of this. Second is the gestation periods for trials, for certifications, for qualifications is very large. Thereafter, once you get qualified, the cycles for production, in fact, the company can produce fast, but the cycles for deliveries and the cycles for realization of your revenue, they are all large. They have their own administrative issues. They have their own administrative lead times. So again, that's the reason why I say it is not for the weak-hearted. So because of this, there is a large number of people who probably do not want to enter into the defense ecosystem or get deterred. There is nothing to get deterred actually, in my point of view, because I've been part of the defense ecosystem. And I know that everything is very streamlined and structured. But you have to meet the requirements.
Right, sir. And just my last question. I think everyone's asked questions about the top line, bottom line today, but my last question is just between the lines. So when the management, you guys come into the room and discuss that you want to be here in 3 years or 5 years, then what are those discussions like? Where do you see yourself, let's say 3 years, and what are those discussions like? Would love to know that beyond the numbers.
You are more than welcome to part of one of the discussions, sir. And then you will not see a jacket sit on my shoulder.
But you'll see who will say.
Anyhow, may I take this opportunity to please request all the August investors and members on this call to please make a visit to my manufacturing facility, because in a place you will not very easily find on the map, a place called Karaj. We have been able to create a company which gives the multinationals a run for their money.
Right, sir.
Next question.
Thank you so much.
Can we have another question?
I will cover.
Thank
I
you,
would like to questions of
Anil Singh, we will take it last.
okay.
Rather than Vinay sir, please go ahead.
Thank you, Roshan. We'll take the next question from the line of Tushar Gupta. Tushar, you can unmute and go ahead, please.
Hello, sir. Thank you for the opportunity. I just want to know two things. First, you have mentioned somewhere that we are working on heat pumps. What is the market size for that, and when we are going to supply these products, and what sort of margin in that? And second question is also on, we are working in a retrofitting side of business. So what is the margin there, and how we are doing that at present?
Okay. Tushar sir, let me answer your second part of the question, retrofitting. And then we will go back to the heat pump side of the story. Retrofitting is, when we talk about retrofitting, is an existing ship where we had to remove the existing plant and HVAC system and put our system. That's an exciting business because it also adds in the future adds a revenue and service spares and service revenue to my top line. Margin point of view, it gives you a little better margin as compared to the new build. Definitely. But it is a little tedious process. About a heat pump, as of today, even though we have a technology available with us, but our focus is on a data center. And once we establish ourselves into a data center, we will talk about a heat pump market.
Heat pump has been heat pump is a matter of interest because of our commitment to the green energy efficiency and sustainable heating solutions. Technology essentially being the same, but as of now, there is no market initiative in that direction.
Okay, sir. So, sir, retrofit margin, how many retrofit business segment, how much revenue contribution it is in the top line in terms of percentage?
This year, it will be around 32%.
Okay, sir. Thank you.
On a whole year basis, not on first half basis, on a whole year basis, I'm talking about.
Thank you.
Thank you, sir.
Thank you, Tushar. We'll take the next question from the line of Ashish Soni. Ashish, you can unmute and go ahead, please.
Sir, regarding this spares life cycle, because that's a higher margin product for us. So, how does it typically work when you develop or retrofit a ship? So I just want to understand that.
Before Commander Kaushik answers to this, let me answer you from very typical point. See, in a defense ecosystem, the spares have been divided into two parts. One is called as onboard spares, where we supply the spares along with the equipment. And the second big chunk which comes is called as base and depot spares, which comes at the middle of a completion of a project. So these are the two different spare business which we are talking about. Now, sir, you can talk about the life cycle. That's a bit.
Okay, see, Ashish, it's like this, that during a ship in its lifetime, it needs to get periodically updated, quite obviously because of the changing requirements and because of obsolescence or degraded performance over a period of time of various equipment. So that is why you have a retrofit business. Retrofit business is something which is extremely important for us because it gives us an opportunity to penetrate the market where we necessarily weren't already existing, where we weren't an existing player. But it gives an opportunity to all players, equal opportunity to all players to enter into that market. So it is a very, very important segment. As far as the spares are concerned, well, like Abhijit has already mentioned, there are two types of spares, OBS as well as onboard spares, because every ship when it gets deployed needs to be able to maintain its own equipment. So they have some spares with them. And they have base and depot spares which cater to two. One is replenish the onboard spares, and second is to cater to depot type of repairs, which are major repairs. So typically you have onboard spares which cater to about a 2-year requirement and a base and depot spare which cater to about a 5-year requirement.
And next question on the export side, because a lot of our companies, Indian companies, are doing exports also. So there is announcement Kochi Shipyard is doing tie-up with some company. So just wanted to understand what's your thought process on export, because now you are established in this area, you want to actually capitalize on this. So exports wise, are we open for tie-ups, and any friendly nations are we working with through government or whatever? Just give us a broad perspective on that.
So what you're hearing, whether it's Cochin Shipyard or whether it's any of the other shipyards, what they're executing are ship orders. At present, these ship orders are moving away from the markets in China, moving away from the markets in Korea, Japan, etc., and moving into newer markets like Vietnam and India. India is an absolute hotbed for new shipbuilding orders because the existing yards in the other countries are extremely full up in their capacities. Plus, of course, there are some geopolitical considerations as well. Now, when a European shipyard or a Canadian ship owner places an order onto, say, a Cochin shipyard or onto a GRSE or any other shipyard, they come with specified vendors who provide the particular equipment. And typically, those vendors are obviously some people who provide or who are called local presence. So if your equipment is not to be fitted on ships which are being built for, say, a German owner, for example, or a Norwegian owner, for example, there is going to be some local presence in that particular geographical area. Hence, at present, Shree Refrigeration does not have that presence and is not looking at that presence at this point in time. However, there are some discussions on which I think it's a little premature, or I would not like to disclose them in entirety at this point in time. But there are some discussions, at least to cover certain naval aspects, may not be the marine aspects.
Last question on EBITDA margin for data center business. So what's the typical EBITDA margin we are looking, and is it only services business? What I understand from your earlier points on the data center business.
So at present, it's a commission plus service.
Let me also add what Mr. Shinde just said. It is not only a commission. The top line will be added to the invoice value will be added to my top line. So it's not only a commission. EBITDA margin is too early for us to talk about it, but we expect the EBITDA margin to be in line with our defense business.
And just one last question. This
Ashish, there are many in queue. We'll request you to please. Yeah.
Thanks.
So we'll take the next question from the line of Akshay Bajade. Akshay, you can unmute and go ahead, please.
Yeah, hi. Thanks for taking my question. So, very quickly, coming back to your EBITDA margins, in the past, you used to do EBITDA margins of anywhere between 27 to 30%, which, sort of converted into 13-14% on PAT side, right? Now you're giving a long-term guidance of about 20 to 22% of EBITDA margins. But however, you're maintaining the fact that your net profit margins will continue to be at 13 to 14%. So there seems to be a little bit of a disconnect here. How is it that my EBITDA margins are falling, but somehow I'm able to maintain my net profit margins going ahead?
So historically, the EBITDA margins were on the lower side of revenue. As the revenue increases, even when EBITDA margins are coming, with higher revenue will be contributing more on the bottom line side. The fixed overheads will not be increasing at the same rate. It will help us to basically depreciation and finance cost will not be increasing at the same ratio the revenue is increasing.
So which means So which means that actually your EBITDA margins will be higher than what you have put in your presentation, right? Because if operating leverage is going to kick in, then and with a higher top line, then it means that you will actually end up achieving margins which were equivalent to what you did in the past or even better than that, right?
So last year's EBITDA was achieved with the product mix, with a different product mix. This year it will be somewhere between 20 to 22%. Hopefully, going forward, with the space revenue increases, the EBITDA margin will also increase.
Understood. Right. My second question, sir, is on. So we wanted to understand the specific opportunity available to Shree Refrigerations out of this entire big build out which is happening on the Navy side, right? So like you said, our number of ships are going to go to 200 ships by 2030, 160 ships by 2030. There are about 2 lakh crores of RFQs which have been floated. So out of this 2 lakh crores or 160 ships, right? What is the addressable opportunity, the market in which we are playing, and how many players, in your view, are operating actively in this particular segment?
So if you just take a very broad rule of thumb, okay, the HVAC segment value of the order of a particular ship project, the value is anywhere around 0.5 to 0.8, 0.9% of the complete order. So that's the kind of opportunity that is available. There are 3 or 4 major players who are there in the market. So theoretically, everybody's got an equal opportunity. 25% or 30% if you divide it equally amongst all the players. However, we have been pretty successful in garnering 50 and upwards percentage of the market share.
Understood. Right. All right. I have a few more questions, but I'll come back in the queue again.
Please, sir.
Thank you, Akshay. We'll take the next question from the line of Deepak Mehta. Deepak, you can unmute and ask a question. Deepak, you can unmute and ask a question, please. So we'll give the chance to all those who haven't got the opportunity to ask the question. So we'll take the next question from the line of Kanai.
Hello.
Yeah, Deepak, please go.
Yeah. Good evening to the management team. Sir, my question is around the what would be the revenue mix in FY27 or FY28 for defense and the data center, and in the data center, how you are planning to go into the market? It is through the partnership or directly, as a single entity for Havoc operation facilities, sir?
Definitely go into a data center with a partnership with a smart DT that we have already published, announced. Already the agreements are signed. So we'll continue work with the smart DT to address to need of a data center cooling solution. One. Now coming back to the question, the first part of the question is the guidance for 27 or 28, FY27 or FY28. That is what we've been trying to say all the time, is that we will grow approximately a CAGR rate of 40 to 50% and 27 as well as 28 both.
Does that answer your query?
Yes, sir. I wanted to specifically ask the revenue mix, if you have any rough goal or yeah.
As Kaushik in his earlier answer just said that we expect a trickling business in FY26, major business coming in 28 from a data center. When we talk about major business, business mix point of view, it will be in double digit.
Okay, sir. I will get into it. Thank you, sir.
Thank you, Deepak. We'll take the next question from the line of Kanhaiya B. Mr. Kanhaiya, you can unmute and ask the question, please. Mr. Kanhaiya, you can go ahead with the question. So we'll move to the next participant. we'll take the question from Mr. Vishal Kumar. Vishal, you can unmute and go ahead, please.
Hello, sir. Good evening. Can you hear me?
Yeah, you are loud.
Sir, first of all, thank you very much for the opportunity. Sir, as you know, as a company, we are always ahead of the curve as far as R&D is concerned. Let it be HVAC solutions or chiller or refrigeration solutions. So I just wanted to understand. You just said that we have almost each player has almost around 25% of market share. So my first question would be in the ongoing projects which Navy is undergoing the warship which are coming. What is our market share? I mean, how the order book which we have told 327 crore. What is the percentage of orders which we have got from Navy?
Just before Mr. Saudi comes in, I just like to correct you a little bit. It is not that all players have got 25%. What I said is, if there are 4 players, theoretically every player has an option of possibility of getting 25%. That doesn't necessarily mean that a particular firm gets 25%. I mean, all the firms get 25%. Could well be some firm gets 40%, other firms get 10% or things like that. Our market share, we have been able to capture upwards of 50%.
Right. And sir, follow up to this, will we be able to maintain the same market share as, there is a huge pipeline for warship coming in?
I don't think we have any doubt about it.
Okay. And
Your expectation is to just maintain a market share. And our expectation is to increase the market share, sir.
And in anticipation of that is where we are enhancing the manufacturing and service capabilities.
Right. And just to understand, sir, let's say if some player wanted to enter this sector, there is a lot of certification and, a lot of R&D involved. So how much time it should take for a new player to settle in this sector?
Vishalji, any chance of you trying to enter into the segment? But jokes apart, sir, we will take this question probably on a separate occasion and separate level, sir.
I just share one anecdote. We imagined to get into naval business in 2012 with the first round coming in 2016-17.
That gives you an answer. We gone through 5 years of a gestation period.
Vishal, answer to your question was given a little bit earlier also. I think when somebody asked how difficult it is for a new entrant to come in. Let's repeat that again. It's a difficult thing and it's not for the weak-hearted. There's a large amount of competition.
Right. Sir, lastly, sir, I just, you have already touched upon the opportunity as far as civil shipbuilding is concerned. So, in how much time should we expect an order? Or, we know we are already doing a lot of R&D and a lot of things are going on. But in revenue, this thing, how much time should it take us to get an order from, let's say, for some cargo ship or something?
See, typically what happens is large shipbuilding is a very capital intensive and there's a large amount of resources that are required for its construction. Luckily, we've already got a couple of very capable shipyards who are already in existence who can handle such kind of big ships. Because merchant ships are usually much bigger in size and dimensions and in the tonnage. So we've already got couple of shipyards who are already capable of handling this kind of larger ships. So I think with the kind of thrust that the government is giving, the kind of impetus that is there, and the kind of kickstarting that the government has been giving, this should happen sooner than later. To begin with, I think some of the smaller ships, that is the tugs, there's also a green tug transition policy which the government of India has decreed, which requires all the auxiliary vessels which help the larger ships to maneuver in and out of the harbour. That's a requirement of about 300 odd, which need to convert into green tugs. So those orders, companies have already started manufacturing that, and orders have already started trickling in. So I think for smaller ships, auxiliary vessels, we should start seeing some realization in the coming years. But for the larger ships, it should happen sooner than later.
That's all. Thank you and all the very best.
Thank you,
Thank you, Vishal.
Thank you, Ishant. We'll take the next question from the line of Abhay Jain. Abhay, you can unmute and go ahead, please.
Hi, thank you so much. Sir, I wanted to ask regarding the 175 CR orders of L1 which you are in. So I wanted some clarity on that, how much you have received, how much is yet to receive, and what is our bid pipeline?
Sorry, 175 crore is something which I not very sure I understood it correctly. What is that question is about 175 crore?
Your L1 orders, that you are L1 in that.
There is some mismatch in the figure which you're talking about. Because
I think this number was mentioned in the RHP is where he's referring from, it seems.
Yeah.
All the orders have been already received, and as of 30th September, we have orders in hand which have been already placed, POs has been already placed, and the amount of which is 327 crores.
Okay, and your bid pipeline?
we just told you that we have 800 plus 200. 800 from a naval ecosystem till 27 March 27, 200 from a non-naval ecosystem. That is marine segment.
Okay, thank you so much, sir.
Thank you.
Thank you. We'll take the next question from Ramchandra ji. Mr. Ramchandra, you can unmute and go ahead, please.
Good evening, sir. Can you hear me?
Yes, sir.
Yeah.
So my question is on the gross margins. So if you look at this 6 months, our gross margins were at 41%. So it has been come down from 45%. So my question was, do you operate on a fixed price contract or on a variable contract where you put a clause telling that we'll pass on the cost if raw material prices go up?
So most of the contracts are on fixed price.
Okay.
About you just compared that 45% to 41%. I think this we've been trying to answer this question by saying a product mix which you saw last year to this year about a service or spares revenue. So obviously spares and service revenue has a much higher percentage of the gross margin. So which you see a difference here. And which is what we have been trying to say that by end of this year, by end of this financial year, our PAT will be exactly at the same percentage level of last year, a little better than last year. Percentage point of view.
Yeah. Sir, and my second question is, you told you'll do an expansion of 50,000 square feet. So how would that financing be? Would it be like equity dilution, or again debt infusion is going to happen, or would it be a mix?
So the fund requirement for the expansion has been available with us, which will be funded out of general corporate purpose funds. And the expansion is expected to complete it by March.
Absolutely, just to answer your question, there is no additional requirement of funds for the planned expansion. It's already catered for.
Okay. Okay. Yeah. Thank you. Thank you.
Thank you. Due to paucity of time, we will take one last question from Mr. Kanaya B. Mr. Kanaya, you can unmute and ask your question.
Last question.
Vinay, we have to also answer to Mr. Aryan Singh. We will answer that at the end of our meeting.
Sure. Mr. Kanaya's line, I think there's some problem. You can answer that question in the meanwhile.
Yeah, go ahead.
So the lower amount of the interest on consolidated financial statement is mainly due to elimination of intercompany transactions. The interest can be linked to Trezor technology on the intercorporate deposits taken from Trezor. The same has been eliminated for the consolidation. Thank you.
Sure.
Mr. Aryan, you are there. I hope you have got your answer.
Yeah. Basically, intercorporate deposits have got offsetted in consolidation is what you're answering.
Awesome.
Yes, thank you, sir. Yeah.
If the meeting is closing, I have two points.
Sure, sir. We would like to invite you to give your closing comments.
The closing comment is I express my heartfelt gratitude to all my members here for really asking highly qualified, well-researched questions, and I hope we have been able to answer that to the hilt. My commitment to Indian Navy goes beyond numbers and all, because the idea is to create a truly strong company which can cater to any amount of technically challenging jobs that the Indian Navy can throw at us, like in Scorpion submarine air conditioning. And we want to be a real beneficiary and benefit the Indian Navy through the government initiatives of Make in India, most importantly, Atmanirbhar Bharat. One important point which does not reflect in any of these presentations because it comes at the end of a financial year and goes directly to the bottom line is that being located in a place like Karad, the government of Maharashtra is giving us a capital subsidy to the extent of 50% of the capital investment in the plant and machinery, including land and building. So we expect a substantial amount as we go on expanding. The eligibility for this subsidy goes on increasing. There is a period of 10 years. So there's a steady stream getting into the bottom line, which helps the company's financials in a big time. And my request to all the present members here, there is an email ID where you can post your questions. We can have a lot of information requests from you. We'll be only pleased to answer all the questions. And thank you for being a part of the growth story called Shree Refrigerations. Thank you.
Thank you, sir. And thank you to all the participants for joining us on this call. That brings us to the end of today's conference call. Sir, you would like to add something?
Yeah, Abhi, you can name it.
The point which I would like to add here as the closing statement is again assuring to the investor community, even though H1 was a little muted, that's because of the reasons which we have.
Business.
Nature of business, we had dealt on a lot of reasons behind it, but we can assure you and we are very confident about that our year end, we will meet our target. We will on the top line as well as at the bottom line. And we will still grow, continue to grow at the CAGR rate which we have been mentioning.
Thank you, Yash. That was a very
absolutely grateful.
Very grateful for your comment. Thank you.
Thank you, sir. And thank you to all the participants for joining on this call. This brings us to the end of today's conference call. Thank you.
My gratitude. Thank you.
Thank you.